Sherry Rikus. Welcome. My partner Liz Zilas and I thank you for joining us for Good Friends, Good Investors. We're very fortunate that we work with many, many women clients. And many of you are on this webinar today. Thank you. But not only are you our clients, you have also become our good friends. So this puts us in a unique position. We know you as both good friends and good investors. Thus, the name of our webinar today, and we're going to show you the common traits of both throughout this afternoon. But before we begin, our firm does a lot of research, and we thought it was only prudent to do some research to look at attention spans. So we had a survey done of a lot of women, and here were the results of our survey. We wanted to see how long women pay attention to webinars. What we found is after 2 minutes, we're going to lose about 10% of you. So I'm looking at my watch. I think I've been speaking less than a minute, so I should have 90% of your attention right now. After 10 minutes, we're going to lose 50% of you. That's a lot. But what was really astounding when we got the survey results back, after 15 minutes, we're going to lose 80% of you. So we decided that we were going to switch speakers at about the 15-minute mark. So I'll speak for a while, and then you're going to hear from Liz. But not only did we want to do research on attention spans, we also wanted to see, so what is our competition? If you're not looking at this wonderful webinar, what are you thinking about? Well, 10% of you are thinking about family. And who doesn't think about family? I know I think about mine all the time. 10% of you are thinking about your hair color and your pedi appointments. And I've got one coming up, so next time you see me, it may be a new look. And actually, fortunately, Zoom is very kind to the hair these days. And 80% of you, and this is a phenomenon we've been hearing a lot, are thinking about happy hour. And happy hour is usually about 5 o'clock, so have no fear. We will be done today well on time for happy hour, probably about 4:30 or 4:45. So we did the research on attention spans, but Liz and I were thinking, well, if happy hour is our competition, let's get some good insight from you. So we're going to have a few polls this afternoon, and we'd like to do the first poll. And this poll is on your favorite happy hour cocktail. So we're going to put the poll up here. Is your favorite cocktail a Moscow Mule, Negroni, Paloma, or Mojito? So vote. I'm actually a Moscow Mule kind of girl, and I've been hearing about this Negroni, and I haven't had it. So if anyone has a good recipe, feel free to send it my way. And the answer is Mojito. So hopefully you all have a little happy hour, maybe a little Mojito when we're done. We're going to start with poll number 2 right now. And this was a really important poll that we looked up. And we were going to do a poll, are men or women better investors? But when we started to put the answers, we said 1 is women, and then 2 was women, because is there really any other answer besides women on men or women better investors? So our research has shown that women are better investors. And I'd like to share that research in a moment here. And I think every good slide loves a visual. So here's your typical male investor. Some of you may find that he looks a little familiar. It's my husband of almost 31 years. He looks pretty cute here, and he's smiling because he actually thinks he's a great investor, like many men. But the research, and there's a lot of research backing this, and you probably will all agree with me and the men you know in your life, men trade more often, men invest more aggressively, and men have lower risk-adjusted returns. So here, women are better investors. I know we don't brag. None of us like to brag unless you're me and you're married to this typical investor, and I do brag about it now and then. But you all do win, and you could have bragging rights. So why are women better investors than men? Well, it's the same skills that we build these long-term friendships translate to being good investors. So let me share this with you and show you why. So we're going to go through all these skills, But each time you see a skill, there's going to be a picture of these girlfriends, and these girlfriends are having fun and they're dancing. And then there's also going to be a picture of successful investors. Now, this woman is also happy. She happens to be throwing her money away, which we don't want our clients to do that, but maybe she's so successful she can do it. But I wouldn't tell you to throw your money away, but I just love this picture, so we're going to go with it. And the top one is girlfriends, and the second picture is successful investors. So now let's explore. Girlfriends maintain their bond through planning. And if you're like my girlfriends, you plan. We are the master of keeping the calendar. We put all of the dates on our calendar. We schedule lunches. We schedule Zoom calls. We make dinner reservations. We schedule time with friends. We make our doctor's appointments. We make our kids' doctor's appointments. We make our parents' doctor's appointments. If something needs to get done, we plan and we get it done. But you know what else? Successful investors reach their financial goals through planning. And us women, we're pretty good at getting organized. And when you are planning, you have to be organized. We often act as a CFO for our families. So here are the many, many things that we plan for. So today I'm going to have a list of items that you should be planning for. And I hope if you have a piece of paper, our goal is that you walk away with a few things that you're going to do from this webinar. And as I go through each of these planning items, maybe jot one or two down that you're going to take care of the next 30 or 45 days. So here's a personal CFO checklist that we work with our clients. And we often come up with 90-day priorities, 6-month priorities, 1 year, but I'll let you determine your own priorities. But these are the items we look at, and we usually begin with asset allocation. Asset allocation is probably the most important decision that you will make as an investor. It's your mix of stocks and bonds. The more stocks you have, the higher returns, but the higher risk. And it's important to look at it every quarter, twice a year, because with the volatility of the market, your plan may have changed. You may have too much stocks, too less stocks, but you need to look at that asset allocation. Now, I can spend a whole webinar on asset allocation and factor in luck. We're going to be doing that. And on June 25th, our partner Dave Rappaport will be doing a whole webinar on Investing 101. We did it in the afternoon, but due to popular demand, we are doing it in the evening, and I'll talk about that later and give you more details on that. But a good plan should be coordinated with your tax attorney, because it's not just what you earn, it's what you earn after taxes. Now, we all love to plan way in the future, and as we know, college costs keep rising and rising. So whether you're a grandparent or a parent, a great way to help your kids or grandchildren is to plan ahead through a college savings plan. The next is charitable giving. Now, it has been very, very tough times, and we know a lot of charities are in a lot of need. And I know you girlfriends and my girlfriends, we are very generous, and we've been donating. But there's a way to donate and give your charitable contributions in a tax-efficient way. You win, the charity wins, and you might even be able to give the charity more money. So a good financial plan has charitable giving strategies. Another big area that we work with clients a lot is looking at their estate plan and making sure their beneficiaries and their accounts are titled properly. I've talked to a lot of estate planning attorneys, and they're very, very busy right now. When was the last time you looked at your estate plan? Was it when your daughter was born, who's now 32 years old? Maybe you didn't even include your other 2 children that you had. So take some time, look at your estate plan, make sure it lays out exactly how you'd like your assets distributed, who your executors are, who your guardians. And once your estate plan is updated, take that next step, because we always see that not taken, and make sure your beneficiaries and your counts are titled properly. Speaking of estate planning, another important area is healthcare powers of attorney. Hospitals and doctors have really gotten more strict about who they will give information to. So make sure you look at your healthcare power of attorney, that it has what you want on there for your wishes. And as an extra credit for some of you overachievers in the room here, if you have children or relatives over age 18, make sure that they have a healthcare power of attorney. My daughter last year tore her ACL, and I called the hospital, and they would not give me information unless, she left the hospital and said she needed surgery. I said, what kind of surgery? So she gave me the name of the doctor. I called the doctor, and they said I needed to send the healthcare power to get more information. So make sure that you have that for your children over 18. It's also a good time to look at all your insurance, your disability, your health insurance, long-term care, liability, umbrella, and make sure that everything is up in order and that you know where it all is and that you're up to date with all your insurance, your payments, and that the coverage is what you like. Cash and liquidity planning. We spend a lot of time with our clients because the market has been so volatile, which you'll hear a lot from Liz later on. And the way to get through that is to know where your emergency funds are. If you should have an emergency and you needed money in 24 hours, where would you get it? Is it from a bank account, maybe your brokerage account? Do you have a home equity? Can you borrow from your 401k? Make sure you know those sources because it makes getting through emergency much easier. I'm a little bit of a nerd. In January, I love to update my statement of net worth. So I take my brokerage, my assets, my home, and I kind of put it all in a spreadsheet and I compare year to year. So I think once a year, maybe twice a year, make sure you have an updated statement of net worth. So all these items will help you get organized, but I know if you're like my girlfriends, we like to plan ahead. We want to go to ABBA. We don't make the reservation the night before. We make it 6 weeks before, and we hopefully we'll be able to make those reservations soon. And sometimes I'm a little behind the times. Maybe ABBA's not the best restaurant, but right now, but I think you get the point here. So girlfriends also know the importance of long-term planning. And these are the 3 questions we get most often. When can I retire? How much can I spend? And will my portfolio last throughout my lifetime? And we have we do a financial plan that's about 30 plus pages. This is just a snapshot. And we run a quantitative tool that runs 1,000 different scenarios, good markets, bad markets, average markets. We take all the inputs, all what our clients' goals and objectives are, and we come up with a probability. And we can look at 3 different scenarios, actually up to 4. We could look at different retirement dates, different spending levels, different asset allocations. We want all of our clients to have at least an 80%, hopefully a 90% probability of success. So as you can see here, all of these scenarios are pretty high in probability of success, and investing is really putting the probability on your side. And that's what a long-term financial plan can do. So that was a lot to go through. So let's look at another skill that girlfriends have. Girlfriends love to talk about their values. They love to talk about what's important to them. I have a group of 5 friends from high school, and we go out for dinner once a month to celebrate our birthdays. We've been doing that for 35 years. Husbands haven't caught on that it's every month and there's only 5 of us, but needless to say, we have a great time. We go out to dinner, we take a step back, and as life moves on, we talk about what's important to us. Well, guess what? Good investors incorporate their values in their financial plan. They don't just run the numbers. They don't just have the numbers run. They want to look at their values and make sure all the decisions on their finances tie to their values. But the problem we see often is when we start to work with new clients, they've never really taken the time to determine what their core values are. So here's a list of about 100 core values. And just to define what a core values act as a guide that help you navigate big decisions you often face. Core values are your strong beliefs, things that are very, very important to you. Now, I have a whole blog called Maximize Your Return on Life, where I talk a lot about values. In the next 6 months, I'll have a book that's coming out, Maximize Your Return on Life, spending or investing your time and money on what you value most. So you want to talk about values, always happy to do so. We'll actually send you a list of the core values after the seminar, but this is a list of about 100, and I've highlighted a few that I see most often: family, philanthropy, health, wealth. And once you know these core values, You can use them when you have big decisions about your time or your money. So now let's look at the next skill. Girlfriends benefit from a diverse group of friends. I'm just looking who's on the webinar today, and I know my friends. We have friends from childhood, we have friends from high school, friends from college, friends from work, friends we know through our husbands, friends we know through our boyfriends. I'm not saying I have a boyfriend, I have a husband. It was a little confusing when we did the dress rehearsal here, but everyone kind of chuckled with that. But if you have boyfriends, maybe you've met friends through them. Your temples, your churches, just your everyday life. And what is great about having all different kinds of friends from different types of your life, it's a diverse group of friends. They offer diverse opinions. So when life is tough, when life is going down, they help pick you up. Having a diverse group of friends has helped me get through many, many times in my life. Well, good investors often benefit from diversification in their portfolios. And diversification is a big, big buzzword in the financial industry. So I'm just going to take a moment to unravel this and kind of make it a little clearer for you. So when we talk about diversification, here's an example here. As an investor, you can own Fund A, Fund B, or Fund C. If you just own one of these funds, you see a lot of volatility, a lot of ups, a lot of downs. But what if you owned Fund A, Fund B, and Fund C in one portfolio? And the green line shows that it's a much smoother ride. You can often actually enhance your return and reduce your risk or have a smoother ride. This is called diversification. You're diversifying among 3 funds instead of owning just one fund. So now you're all in for a treat. Many of you who've been on my webinars before, or actually they weren't webinars before, they were individual presentations before, will notice that this is my favorite chart. I call this chart the mosaic chart, and it's a very pretty chart. It's suitable for framing, and we purposely didn't label it, but what this chart shows, it shows every area of the market is designated by a different color. And the areas on the top were the squares on the top by the colors were the best performing areas of the market, and the squares on the bottom with all the different colors were the worst performing areas of the market. And people try to look at this chart and make assumptions and try to figure out the best investment strategy. But even if you just squint your eyes and look back, what you find is there's no pattern. It's random. There's no color on the top all the time, and there's no color on the bottom all the time. But there's a few extreme examples, and I want to show you one here going back to 2007. 05, 06, 07 was some very, very good returns in the market. And in 2007, where all the areas of the market averaged about 5 to 7%, there was one area on the top that was up 39%. So if you own that area, you were thrilled. But the next year, 08, this was the financial crisis, everything was down. US market down 37%. But that area that was up almost 40% in 07 was down 53% in 08. So a lot of investors panicked. They lost more than half their money in that area of the market, and they decided to get out. Not our clients, because we hold hands, we keep clients disciplined, we keep them long-term. But look what happened in 09. See that last circle? Up 79%. So those that got out were probably pretty sorry. So we're going to have a little fun, as much fun as you can have looking at statistics and numbers and returns. And I'm going to do poll number 3 here. So what area of the market performed the best in 07, the worst in 08, and the best again in 09? Was it US large company stocks, US small company stocks, emerging market stocks, or real estate? Well, a lot of you were right. It was the emerging markets. And emerging markets includes the undeveloped foreign countries like China, Taiwan, South Korea. And you can see here, the volatility in that. So if you picked emerging markets, you were right. I'm going to turn it over to Liz in one moment, but there's just another very extreme example I want to show on this chart. In '08, remember I told you everything was down, and the dark blue is the US market. US stocks, large company US stocks were down 37% in '08, so it was very, very tough. The next year, US stocks were up 26.5%, so everyone was thrilled. They took a sigh of relief. But remember I showed you emerging markets was up 79 and international was up, the yellow was up 48. So often we get answered, shouldn't I just own US stocks? We've done a lot of writing on this, and we believe having a diversified portfolio that owns US stocks, international stocks, emerging markets, real estate, and the stability of bonds in a mix tailored to you will actually help you achieve your goals. So now I'd like to turn it over to my partner and good friend, Liz Zilas, that will continue why good friends make good investors.
Thanks so much, Sherry. So one of my most favorite things about my girlfriends is that they tell it like it is. And I hope they feel the same way about me. I am open, I am honest, I am upfront, and I am transparent. Such important qualities of good friends. And when it comes to investing, successful investors are pretty good at seeing right through those that don't tell it like it is. And guess who the number one culprit is when it comes to not being straight with their investors? You guessed it, Wall Street. The big brokerage firms and mutual fund companies that tell you that they can predict where the markets are going or which stocks are going to do well and when. Wall Street tells you that they can find the needle in the haystack. They want you to think that all of their high-priced research, analysts, and strategists are so smart, smarter than you, and that they can see into the future and that they are actually the only ones with a crystal ball. But there's a better approach to investing. Instead of trying to find that needle or pick the winners, it makes more sense to own the haystack. Owning the haystack means owning all of the stocks in a particular area of the market rather than just trying to pick the winners or the needle in the haystack. But don't take my word for it. Girlfriends, we like to check things out for each other. So let's check out this research together. Here's a study that takes a look at the 15 years ending 2018. At the start of the period, there were 2,786 mutual funds that took that find the needle approach. They were trying to pick the winners. But 15 years later, how many actually did find those needles? Not that many. Actually, only 18% beat the own the haystack approach. So we say we would rather be on that 82% side of that study any day. And so we choose to own the haystacks for our clients. Okay, let's move on to another skill that girlfriends have. Girlfriends love to share a good deal with each other. We love to talk about what's on sale, how to find the best discounts, in general, how to be good and smart shoppers. And you guessed it, successful investors are also focused on keeping their costs low. They focus on the expenses that they are paying and keep them as low as possible. Why? Because successful investors know that funds that have low costs are much more likely to have better performance than funds with higher costs. And actually, Morningstar is a firm that rates mutual funds, and they agree with this wholeheartedly. A recent study that they conducted looked at the relationship between fund costs and fund performance. And according to them, in every time period they looked at, low-cost funds had better performance than the higher-cost funds. They concluded that investors should use the level of fund expenses as a primary test in picking the funds to invest in. This Morningstar study is summarized nicely on this cocktail napkin. Cocktails, happy hour, you get the gist. And which some of you may have actually seen in the New York Times. That's where it was published. It shows very clearly that the higher the expenses, the greater the chance a fund will stink. And we do not want our good friends or our investors owning funds that stink. If we actually open up the hood a little more and look at the difference in costs between needle funds and haystack funds, it's quite remarkable. Another study conducted by Morningstar shows the average mutual fund expense for those needle funds are more than 4 times the cost of the Haystack funds. 4 times more for worse performance? That is definitely not a good deal. So let's take a look now at one of, in my opinion, the best qualities of girlfriends. We stick together during rough times. Girlfriends are the ones that arrange meals for you when you are sick or have just had a baby. They're the ones that know when you need to talk, and they are the ones that know when you just need a glass or maybe 2 of wine. In the same way, successful investors stick it out during tough times as well. They stick to their plan and do not throw in the towel because the markets are having rough or even really rough times. Now, even though the markets have been doing a bit better since March, I think it is safe to say we are still in a very unsettling time in our lives. So, should we stick with our plan? Should we stay invested through these tough times? Let's hear what you have to think. So, we're going to have a poll in a minute, but these are the 4 choices. Invest in the middle of a pandemic? Are you kidding me? Next, Bitcoin. I'm curious to see how many of you pick that. If you're my friend, probably not. Next would be cannabis stocks. You think they may go higher, or maybe you will go higher. Sorry for that. Not really that funny, but sort of funny. And fourth, yep, thought we were in tough times. Let's stick to the plan. Now, this is not really, it's a good poll, but I'm hoping that all of you chose number 4. And it looks like, yep, most of you did, but some of you were trying to be funny and pick the other ones. But yes, stick to the plan. So sticking to the plan when you're emotional may not be easy. We know it can become a very emotional endeavor. You can be optimistic when the market's up, then you could even get elated when it, if you owned Amazon and Facebook and all of those during, their heydays. Then you could get nervous, fearful, maybe even terrified, which is something that we witnessed just recently with many of our clients. It was a pretty terrifying thing to watch these markets drop as precipitously as they did. But guess what? We came right back to being optimistic. So do you think that you can use your emotions or maybe your insight into knowing when to get in and out of stocks? Not sticking to that long-term plan, but trading in and out, timing the market? I got to tell you, that's a really, really tough thing to do. Here's the question you really have to ask yourself before doing so. What do you know that everyone else hasn't already figured out? Or as we like to say, what do you know that is not already baked into stock and bond prices? As this chart shows, every single day, lots of people are buying and selling. Over $440 billion of stocks trade every day the exchanges are open. So when you're selling because you are convinced, or you've convinced yourself that stocks are going down, there probably is someone smart that is on the other side of that trade that is buying. This recent downturn and then the more recent upturn really shows that if you don't want to stick to your long-term plan or are having second thoughts or feeling nervous about it, you still must ask yourself 2 more questions before making any rash decisions. When do you get out and when do you get back in? So here's my favorite chart, and it shows how stocks have reacted to the COVID-19 pandemic. This shows U.S. large company stock performance for 2020 through June 3rd, just a couple of weeks ago. As most of you know, through mid-February, stocks continued to do well. They continued the gains that they had last year. But in mid-February, the virus became front page news and the lockdown started in early March. Stocks plummeted, going down 34% in a really short period of time. Do you really think that you would have known just when to get out? And if you did, you would have been stressed out like crazy trying to figure out when to get back in. Would you really have invested at the bottom during the 3rd week of March in time for that 39% upturn? I'm not so sure. The better approach is thinking long-term and sticking to the plan. The plan that we put in place for our clients is for the good times and the bad times, but the important piece of that is sticking through it no matter what. So we've been through tough times before, and staying the course has certainly paid off, as this chart shows. So here we are looking at the US stock market performance going back to 1926. The blue on the top shows bull markets, when stocks are going up, and the red on the bottom shows the bear markets, when stocks are going down. What do you see? Lots more blue than red. And also, after the red down periods, you are usually in for a long blue up period. So again, just stay the course. Okay, let's look at the last skill that girlfriends have. Girlfriends tell you when you need some help. It could be something funny, like when you need your hair color, or it may be something more serious when you really need someone to turn to. Successful investors also understand the value of help, and so they look to their advisors to help them meet their goals. I know there may be an appeal in doing it yourself. Money is a really personal thing, but looking at long-term goals and how to get there involves answering a lot of questions. Focus on what you can control. You can't control the ups and downs of the markets, but with some help, you certainly can get organized and have clarity over your finances. You can have an investment plan in place that lets you sleep well at night. We may be losing some sleep, but at least it allows you to sleep at night. You can stay disciplined and think long-term. And you can take advantage of the silver linings of market downturns by rebalancing and tax trading, something we did for our clients in March, which we know or hope that they are going to appreciate for a long time. Wow, we certainly have been through a lot, and I hope all of my girlfriends, and even if you're not my personal girlfriend, but you're still with us. So let's just take a moment to summarize what we have learned in this webinar today. Good friends maintain their bonds through planning. Good investors reach their goals through planning. Good friends talk about their values with each other. Good investors incorporate their values into their investment plan. Good friends have a diverse group of friends. Good investors have a diversified portfolio. Good friends tell it like it is. Good investors see through those that don't tell it like it is. Good friends love to share a good deal with each other. Good investors like to keep their costs low. Good friends stick together during tough times. Good investors stick to their plan during tough times. Good friends tell you when you need some help. Good investors look to their advisors for some help. And I'd like to mention just briefly how our Maximize Your Return on Life solution incorporates these skills. So we get our clients organized and clarify their finances. We incorporate their values into a comprehensive financial goal plan. Our value-added indexing approach incorporates those haystack funds we talked a lot about. And we monitor and continually update plans and portfolios as our clients' life circumstances change. I'm going to turn it back over to Sherry now to give some closing remarks, but thank you so much for being with us this afternoon.
And thank you, Liz. And thank you all for joining us today for Good Friends, Good Investors. Every few weeks, we've been offering some webinars. We did one on smart money habits for college graduates and young adults. We did one on security measures to keep your financial information safe. We also did one, Investing 101, which I mentioned. We did it in the afternoon, and due to popular demand, we are going to be doing it again on June 25th at 7:30, and we'll be, our partner Dave Rappaport will dig deeper into Investing 101. If you want to see a replay of any of these webinars, you can go to rrcapital.com, and you can find it under the webinar tab. So thank you again for joining us. I hope you will have time, which I think we've left time for happy hour. Maybe enjoy a mojito or two this evening, maybe just one. But have a good evening. Thanks for joining us. And Liz and I, thank you. Liz, do you want to say goodbye?
Bye, everyone. Thanks so much.
Thanks for joining us.
Enjoy your cocktail.
Oh, sorry, I just cut her off. Go again, Liz.
Enjoy your cocktail, everybody, and thanks for being with us.
Yeah, great. Well, we hope to see you at our next webinar. Thank you.